All right, welcome to the market this week. Look, there is so much noise out there, right? So we're going to cut right through it, get to the data, and see what's really going on. Let's dive in.
So there's this one big question that's been bugging, just about everyone. Investors, policymakers, you name it. For months, all we've heard is the economy is slowing down. But is it? The latest data is telling a surprisingly different story.
Okay, so check this out. This chart is from Goldman Sachs, and it's their surprise index. Basically, when this line goes up, it means the economic data is blowing past what all the experts predicted. And as you can see, it's been surging. Recent numbers on services, trade, unemployment, they've all been way stronger than expected. It's painting this picture of a really resilient economy.
But here's the catch. This unexpected economic strength, it throws a huge wrench into the one story that everyone is obsessed with right now, the fight against inflation. So, Bank of America kind of set the stage for this. They put out this note flagging that inflation was looking firmer, a bit hotter than people thought. And that got everyone really on edge for this week's big number, the CPI report, the Consumer Price Index. That's our main scorecard for how fast prices for everyday stuff are rising.
Okay, so this is where it gets really interesting. Let's look under the hood of that inflation report. Yeah, sure, some things got cheaper, like used cars, but look at these other categories, what the pros call sticky inflation. We're talking public transport, hotels, services, they jumped a lot. And that's the kind of inflation that's really tough to get rid of, because it's usually tied to wages, and wages don't just drop like the price of a used car. Now, to be fair, you gotta zoom out and look at the big picture. And when you do, you can see we've made some incredible progress over the past year. Core CPI, that's inflation without the wild swings in food and energy prices, it's gotten way closer to the Fed's 2% target. But you can also see the problem, right? That last little bit, that last mile in the fight against inflation, it's turning out to be the toughest part of the whole journey.
And boom, here's the consequence. This chart is basically the market's live betting odds on what the Federal Reserve is going to do next. And because inflation is being so stubborn, traders are now pushing back when they think the first interest rate cut will happen. You're even hearing some whispers now, could another rate hike actually be on the table later this year? Crazy, right? Okay, so inflation is sticky. But what about the actual economy? How is it holding up through all of this? Let's take a look.
So, you've got this really fascinating, almost bizarre disconnect happening. On the left, you see the hard data. We're talking actual numbers on spending, production, jobs, and that stuff just keeps climbing. But then you look at the soft data, which is basically just surveys asking people how they feel, and it's still pretty gloomy. But here's the twist. The chart on the right looks at social media sentiment, and that's actually holding up pretty strong. It's a real puzzle, right? What people are doing doesn't seem to match up with what they're saying.
And don't think this is just a temporary blip. Big players like Goldman Sachs are now forecasting that the U.S. economy is going to keep outperforming, growing faster than most other economists expect, not just this year, but all the way into 2026.
So you've got a strong economy and sticky inflation. That's a really complex mix for investors. So you know what? Let's take a quick tour across the different markets and see how everything is reacting. First stop, the bond market. And honestly, what's wild here is how calm it is. This chart shows the MOVE index. Think of it like the VIX for stocks, but for bonds. It measures expected volatility. And despite all the drama and headlines about the Fed, bond market volatility is just chilling near 4-year lows. It's surprisingly stable.
And this quote it absolutely nails the vibe right now. The ratio of macro drama to price action is at an all-time high. I mean, there's just so much noise and debate and drama out there. But the markets themselves, they're staying remarkably contained.
Okay, so if the market's calm, what should stock investors be focused on? Valuations. It all comes down to valuations. This chart basically shows that when stocks are expensive, meaning the price-to-earnings ratio is high, future returns tend to be low. And that orange circle on the right? That's where we are right now. Historically, that spot suggests pretty blah, maybe even slightly negative, returns for the main S&P 500 index over the next 10 years.
But here's the thing. The market isn't just one monolithic entity. If you look past the handful of giant tech companies that dominate the main index, and instead you look at the average stock, where every company gets an equal vote, the forecast is way better. We're talking a potential 6% per year. That's a huge divergence between the biggest names and everybody else. Meanwhile, let's hop overseas for a second, because one of the biggest stories globally is Japan. I mean, after decades of going nowhere, its stock market is on an absolute tear, just blasting through to new multi-decade highs.
And this isn't just some stock market bubble.
No, this is backed by a massive shift in the real economy. Japan's 10-year government bond yield, that's the interest rate their government pays to borrow money, just hit its highest level since 1999. That's a huge signal that investors finally believe in real growth and inflation there, which is a total game changer after decades of stagnation.
All right, let's swing back to the world of crypto. The mood has definitely shifted there. As those hopes for a quick Fed rate cut have faded, we're now seeing some pretty big outflows from crypto funds, basically reversing all the money that was flooding in at the start of the year.
All right, last stop on our tour, commodities. Let's look at the raw materials that really power the global economy and see what signals they're sending.
So you hear a lot about geopolitical tension in the news, and you'd think that would send oil prices soaring, right? Well, the longer-term outlook is actually the opposite. This forecast from Goldman Sachs sees global oil inventories piling up, which they think will push the price of Brent crude all the way down to an average of just $56 by 2026. Now compare that to gold. It's a completely different story. Ever since 2022, when Russia's central bank assets were frozen, we have seen this massive, relentless buying from other central banks all around the world. They're diversifying their savings, and it has created this incredibly powerful and steady demand for gold.
And you want to talk about a comeback story? Look at uranium. With this huge global push for clean, reliable nuclear energy, we're seeing forecasts like this one from Bank of America calling for a massive price surge. We're talking over 50% in the next couple of years.
Okay, we've looked at a ton of conflicting data, right? Strong growth, stubborn inflation, calm bonds, stocks all over the place. So what's the real signal in all this noise? What's the big takeaway?
It really feels like the biggest challenge for all of us right now is this huge gap between perception and reality. You've got these dramatic headlines screaming at you every day, but the markets themselves are pretty calm, and the real economy is just quietly chugging along, stronger than anyone thought. So the big question you have to ask yourself is, which one is right? That's the puzzle we'll all be trying to solve in the weeks and months to come.